If I handed you the phone number of the world's best traders and you could ask them anything, what would you ask first? How they find the perfect trade or how they survive the wrong one? Because that is the real secret of market wizards. Jack D. Schwager did not write a book about predictions. He wrote a book about people who learned to win by learning how not to lose. Today, I'll walk you through the biggest lessons from market wizards in a way you can actually use. We'll talk about risk, discipline, psychology, and the quiet habits that separate amateurs from professionals. And by the end, you'll have a simple blueprint you can apply to trading, investing, and honestly, any high-pressure decision in life. Let's begin. Market Wizards. What this book really is. Market Wizards is a collection of interviews, not with academics, not with people selling easy answers, but with real traders who operated in the wild, where the scoreboard is cash, and the penalty for ego is pain. Schwager's goal is simple. Find out what the best traders in the world actually do, how they think, and why they keep winning even after brutal losses. And what makes the book powerful is this. These traders are different from each other. Some are technical, some are fundamental, some are trend followers, some are short-term, fast decision makers, some are quiet, patient, and systematic. They disagree on strategies, they disagree on indicators, they even disagree on what matters most. But they share a few core principles. That is where the gold is. The first big shock. The best traders do not worship being right. One of the most repeated themes across the interviews is almost offensive to beginners. The best traders do not need to be right. They need to be profitable. That sounds obvious until you realize how most people trade. Most people trade like this. They form an opinion. They get emotionally attached. They want to prove they are smart. And then they hold and hope and defend the position, even when price is screaming that they are wrong. The wizards do the opposite. They treat a trade like a business decision, not an identity. If the trade is wrong, they exit. No drama, no negotiation, no praying. And this is not because they are cold robots. It is because they respect the market more than they respect their ego. Here is a mindset you hear again and again. My job is not to predict. My job is to manage risk and let probabilities work. That single shift changes everything. Lesson 1. Risk is the first language of professionals. If you only remember one idea from this entire summary, make it this. The best traders think about risk first, not reward first. Before they enter a trade, they already know where they are wrong, how much they are willing to lose, how big the position should be, and what conditions would make them exit, even if they are still technically in profit. Because they understand something most people never internalize. If you manage risk, you get to stay in the game. And if you stay in the game, you eventually catch the big opportunities. So many beginners obsess over entries, but entries are not the edge by themselves. Survival is the edge. Professionals survive long enough to let skill matter. Think about it like this. If you take a series of trades and you have 1 or 2 losses that are massive, they can erase months, sometimes years, of good decisions. So the goal is not to avoid losing. The goal is to keep losses small and controlled and boring. The wizards do not let a loss become a disaster. They treat risk like gravity, always there, always respected. Lesson 2. Cut losses fast and do it without emotion. There's a line of thinking in the book that shows up in different forms. When you are wrong, get out. Not later. Not after one more candle. Not after the market finally understands your genius. Now. Why? Because small losses are a fee. Big losses are a career threat. The best traders accept that losses are part of the business. They do not take it personally. They do not try to win back the money immediately. They take the loss, step back, and wait for the next clean opportunity. And if you want this to sound practical, here is a principle you can actually run. Before you enter any trade, you must know the exact price level where you will exit if wrong. If you do not know that level, you are not trading. You are guessing. That stop level can be technical. It can be volatility-based. It can be time-based. The method is less important than the discipline, because discipline is what makes strategy real. Without discipline, strategy is just a fantasy. Lesson 3. Position sizing is the hidden weapon. Most people think trading is about picking winners. The wizards teach a more uncomfortable truth. How much you bet matters as much as what you bet on. In Market Wizards, you see traders who are not obsessed with being active. They are obsessed with sizing correctly. They scale up when the odds are in their favor. They scale down when conditions are unclear. And they understand the math of survival. If your position is too big, you cannot think clearly. You become emotional. You start seeing what you want to see. You stop following your rules. And here's the cruel part. Even if you have a real edge, oversized positions can still destroy you before the edge has time to play out. So the pros keep their risk per trade controlled. They avoid the trade that can kill them. They may lose today, but they refuse to be wiped out. That is why they are still around. Lesson 4. The market does not pay you for effort. This is one of the most grounding ideas in the entire book. The market does not care how hard you worked. It does not care that you were due for a win. It does not care that you read 10 reports and stayed up late. The market only pays for being right in the right way, with the right risk. That means you can do everything you think is correct and still lose. And you can make money while feeling uncertain, as long as your process is solid. This is difficult for humans, because we want fairness and we want effort to equal reward. But in trading, the only thing you control is process. So the wizards become process-focused. They become almost stubborn about their rules. Not because rules are magic, but because rules protect them from themselves. Now, let's get into the heart of market wizards, the common traits. Schwager interviews different traders with different styles, and yet patterns emerge. Here are the biggest traits that keep showing up. Trait 1. Independence. The best traders do not need the crowd to agree. They do not trade headlines. They do not trade social approval. They do their own work. They form their own view. And they do not panic when the market disagrees temporarily. They understand that if you need certainty, you will always arrive late. Markets move on doubt. They move on imbalance. They move before the story becomes obvious. Trait 2. Emotional control. This does not mean they feel nothing. It means they do not let emotion drive decisions. Fear and greed still show up, but the wizards built systems, routines, and rules that keep emotion from controlling the steering wheel. Trait 3. Adaptability. Markets change. What worked can stop working. Volatility regimes shift. Crowding shifts. Rules change. Liquidity changes. The best traders evolve. They do not marry a method. They marry learning. Trait 4. Patience. This is not the glamorous one, but it might be the most profitable. Many of the best traders wait. They wait for their setup. They wait for alignment. They wait for a moment where the risk is clear and the reward is meaningful. They do not trade out of boredom, and that alone puts them ahead of most people. Let's talk about a few legendary ideas inside the interviews. Instead of trying to cover every single trader in the book one by one, let's extract the most useful ideas, and I'll frame them like stories you can remember. Story 1. Trend following and the humility to ride the market. Several traders in the book emphasize trend following in one form or another. The core idea is simple. You do not need to predict the top or bottom. You need to align with the direction that is already winning and stay with it longer than feels comfortable. Trend followers often look wrong at the beginning. They enter when the move is starting, not when it is obvious. They get stopped out sometimes, and they keep coming back. Because when the big trend arrives, it pays for many small losses and then some. The emotional difficulty is huge. Humans want to take profit quickly. We want to feel smart. We want closure. But trend trading often requires the opposite. It requires holding when you feel like you should take money. It requires staying in while headlines get scary. It requires letting winners run. That is why so few people do it well, not because it is complicated, because it is psychologically uncomfortable. So here's the practical takeaway. If you cut winners quickly and let losers grow, you are flipping the natural advantage of markets against yourself. The wizards flip it back. Small losses, big winners, that is the asymmetry. Story 2. The power of being selective. Some traders and market wizards talk about having fewer trades, but higher conviction. They do not want action. They want opportunity. Imagine two traders. Trader A takes 20 trades a week because they cannot sit still. Trader B takes 3 trades a month because they wait for a setup they truly understand. Trader A feels productive. Trader B looks lazy, but over time, Trader B often wins. Why? Because selectivity is a filter. It reduces noise trades. It reduces emotional damage. It reduces commissions and slippage, and it increases focus. One wizard-like habit you can adopt today is this. You are allowed to do nothing. You are allowed to wait. In markets, patience is a position, and sometimes it is the best one. Story 3. Losing streaks do not mean your edge is gone. One of the hardest parts of trading is surviving the emotional storm of a drawdown. Even with a solid strategy, you can experience a long stretch of losses. That is normal. The best traders and market wizards understand that variance is part of the game, so they build for it. They do not increase risk to get it back. They do not abandon a proven method after a rough month. They do not start chasing new indicators like a desperate person chasing a miracle. They review, they measure, they stay calm. And most importantly, they reduce risk when they are out of sync. That is a very professional move. When things are not working, the goal is not to prove yourself. The goal is to protect capital and clarity. Story 4. Confidence is earned, not declared. Many people confuse confidence with loudness, but in market wizards, real confidence sounds quiet. It sounds like, I know my process. I know my risk. I do not need to force a trade. I do not need to win today. I need to trade well. That is grounded confidence. It does not require the market's permission. It does not collapse after one loss. It comes from repetition, journaling, and proof over time. If you want the John voice version of this lesson, it goes like this. Confidence is not believing you are always right. It is trusting that you will behave correctly, even when you are wrong. Now, let's build your takeaway framework. Here is a clean, practical way to apply market wizards without needing to become a full-time trader. Think in 5 steps. Step 1. Define your risk before you enter. Ask, where am I wrong? Not where do I hope it goes? Not where I will panic. Where, logically, is my thesis invalid? Then decide how much you are willing to lose. A real number. When risk is defined, fear gets smaller because uncertainty gets smaller. Step 2. Size the position so you can think clearly. If the position is so big that you cannot sleep, it is too big. This is not motivational kalam. This is math and psychology. Oversizing destroys decision quality, and decision quality is the only edge you truly control. So size the trade so your rules can survive a normal move against you. Step 3. Plan the exit for both loss and profit. Most people plan the entry and improvise the exit. Pros plan both, if wrong. Exit without debate. If right, have a method to stay in long enough. You can trail stops, you can scale out. You can use structure, but do not enter with no exit plan. That is not bravery, that is negligence. Step 4. Measure yourself by process, not outcome. A good trade can lose, a bad trade can win. So you must judge yourself by whether you followed your plan, not whether the market rewarded you immediately. If you reward yourself for random wins, you train bad habits. If you respect a disciplined loss, you train professionalism. Step 5. Build feedback through journaling. Almost every serious trader eventually becomes a student of their own behavior. Write down why you entered, what you saw, what you felt, how you exited, what you would do differently. You are not just logging trades, you are training awareness, and awareness is where consistency begins. Let's address the biggest myth Market Wizards destroys. The myth is, there is one perfect system. Market Wizards shows the opposite. These traders win with different strategies. So what is the common thread? Not a system, a philosophy, a risk mindset, a discipline mindset, a psychological mindset. Here's the truth in one sentence. There are many ways to make money in markets, but there are fewer ways to keep it. Keeping it requires rules, humility, and emotional control. That is why Market Wizards is timeless. It is not a strategy book. It is a professional mindset book, disguised as interviews. A few deep lessons that deserve extra attention. Lesson: you do not need to trade all the time. Being active is not being effective. In fact, a lot of trading is self-sabotage disguised as productivity. Sometimes the best move is to wait for clarity, wait for volatility to normalize, wait for the market to show its hand. Lesson: the goal is to find a style that fits your personality. This is a big one. Some people are naturally systematic. Some people are discretionary pattern readers. Some people love macro stories. Some people love momentum. In Market Wizards, you can see that success is not about copying a trader's method. It is about copying their discipline and then finding your own method that fits you. If your style fights your personality, you will break your rules. So ask yourself, do I need structure, like a checklist? Or do I need flexibility with clear risk boundaries? Do I perform better with fewer decisions or more decisions? Do I get impatient easily? Your answers matter. Because consistency is not just strategy. Consistency is strategy plus self-knowledge. Lesson: the market will find your weakness. If you have a weakness, markets will punish it. If you overtrade, you will get chopped. If you hold losers, you will eventually face the one loss that crushes you. If you chase, you will buy tops and sell bottoms. If you cannot accept being wrong, you will keep paying tuition. That is why trading is personal development with receipts. Market Wizards makes that very clear. Let's turn this into a memorable summary. If I had to summarize Market Wizards in a few lines, I would say, the best traders are not the best predictors. They are the best risk managers. They protect capital first. They let winners grow. They cut losers fast. They stay emotionally grounded. And they build a process they can repeat for years. That is the book. Not magic, not secrets, just professional habits, repeated with discipline. Outro, a grounded challenge for you. Before you close this, I want you to do something simple. Pick any market you follow, stocks, crypto, forex, commodities, anything, and write down 3 rules you will follow for the next 30 days. Rule 1, how much you risk per trade. Rule 2, where you exit when wrong. Rule 3, how you will let winners run. Then, keep a journal, not a fancy one, a simple one. Because if Market Wizards teaches anything, it is that success is not built from one brilliant trade. It is built from 1,000 ordinary decisions, made correctly, even when you do not feel like it. And if you want, tell me in the comments, which lesson hit you the hardest? Cutting losses, patience, position sizing, or trading psychology? If you enjoyed this summary and you want more like it, share it with a friend who loves markets, and subscribe for the next book breakdown. Until next time, trade small, think clearly, and stay in the game.